Hi folks, and welcome back to Meaningful Money. Okay, here I am still at Porthcurno Cove. I had to turn the camera around now because the sun's come out so lovely. Facing that way you couldn't see diddly squat. So I'm perched on the steps of the lifeguard house rather, so I hope that's okay, not quite so pretty a view. Just a one-off today. It's almost like an addition to way back when I looked at all the different things you can invest in, portfolio building blocks. It's a sort of mini-series I did back in August, I think, last year. Because I just want to talk very briefly about emerging markets, because it's a hot topic, and if you're interested in investing at all, you'll read quite a bit about it. But what are they? Well, emerging markets is a term used to describe a bunch of countries which are, as the name suggests, emerging. That means becoming more developed. Now, the term that used to be used was something called less economically developed countries, but that was deemed to be a little bit negative, so somebody coined the phrase emerging markets. Now, that's potentially a little bit misleading, but I'll come back to why that's the case in a minute. So these are countries which are developing, so not the developed nations like the UK, the US, the big European nations, or Japan, places like that, but developing countries. Countries which are sorting out their economies. They are building airports and ports and roads and stuff at an incredible rate, which are their sort of industrial economies are growing. Now, why would you invest in these? Actually, the first thing to say is that emerging, it's a bit subjective, that, because there's no sort of objective measure, as far as I've been able to find anyway, as to what emerging actually means. It's obviously, it looks as if it's going up, going forward, but it's quite possible for an emerging market to actually go backwards, as I'll talk about in a minute. So, emerging markets, why would you invest in them? Well, they have potentially incredible growth for your money. So you can invest in these markets, and because some of them, certainly places like China and India and others, are growing at an incredible rate, Brazil, for example, your money can do incredibly well in these places. But the flip side to that is, because they're less developed, their economies are more volatile, more sort of susceptible to shocks and things going wrong. So your money is at risk in these places, more so than it is in the developed economies. Now, when you're investing in emerging markets, you'll hear some acronyms. The most used one is BRIC, that's B-R-I-C, and that stands for Brazil, Russia, India, and China. That's the sort of biggest. You can buy BRIC funds which invest in just those four countries. Another acronym which is starting to hear more about it in my sort of day-to-day job is CIVETS, that's C-I-V-E-T-S, and that stands for Colombia, Indonesia, Vietnam, Egypt, Turkey and South Africa. They reckon these are the ones coming up behind the BRICS. So the BRICS are the sort of leading emerging markets, and the CIVETS are the ones coming up behind. You may also hear something called the Next 11. That's another whole bunch of countries. It includes some of the CIVETS, but there are a whole load of other ones as well. So these are sort of countries which seem to be sorting out their economies, seem to be doing well, and which you can make a lot of money in if you invest in, but they're high risk. So when you're thinking about investing in emerging markets, these are some things to consider. Firstly, only use money that you're prepared to lose a lot of, okay, even all of it. It's very unlikely, but only invest money you can afford to lose. I have 2-3 clients where they said to me, I've got £5,000-10,000 I want to take a punt with. Now, they've done all their financial planning, the money they need to be in place to achieve their aims, that's all sorted. This is extra money that they want to have a bit of fun with. And so we've done some emerging market stuff, and they know the risks and they're prepared to lose it. So only invest money you can afford to lose. Emerging markets, that phrase, doesn't mean that these economies are going in one direction only. It could be that they could become less developed. Argentina is an example which went from a more developed country to a less developed country, so I'm told. If you must invest, I would urge you to keep it as a small percentage of your total investment portfolio, so it becomes a sort of peripheral money. which sort of is a subset really of the don't invest more than you can afford to lose. Keep it at the periphery of your investment strategy rather than at the core, unless you really need your money to work very hard. But as ever, take advice on these things. And if you're going to invest finally in emerging markets, do it using index funds. Now, you can, if you're very brave and if you have an analytical mind, you could perhaps research the best Chinese companies to invest in and buy individual shares. But for the vast majority of ordinary retail investors, the easiest and best way to get into these markets is to buy funds, index funds, or actively managed funds, which specifically invest in these markets and spread your money around for you. So that's emerging markets, something you'll hear a lot about and are probably reading a lot about if investing is your thing. So where are we going next? Well, I've been asked actually by a couple of people to do a mega ultra basic series, literally what is saving, what is investing. So I'm going to do 3 or 4 along those lines. So these are ones for people absolutely brand new who've never read or heard anything about what it means to manage money. So we're going on to ultra basic next. So thanks for watching and goodbye from the lifeguard hut at Porthcurno Cove.